This is a recording of a recent Twitter Spaces that I did with Mike Green. He'd recently done a podcast with Macrovoices, and I threw out a couple of questions on the back of it and made a comment that it got to a certain point of the discussion where Eric very quickly jumped to a completely separate topic, which I thought was super interesting and had been skipped over. So Mike was very gracious to give me his time to go through some of that. The first, it all centers around passive. It's just this time, instead of specifically about equities, we talk much more about the impacts on the bond side, and then sort of transition into the implications of the Fed, the decisions that are being made, and potentially why they're the wrong decisions for the wrong time. So yeah, I hope you enjoy it. Thanks very much. Kind of threw out a reply to a tweet in reference to your interview with Eric of Macrovoices.
Yes.
Which you happily replied to, and put yourself out there and said, I'm happy to talk about it. The one thing I went back and had a listen to it earlier on today, and I went and had another read of the was it pensions and investments online, or whatever it was?
Yeah, the article on and my Substack actually was focused on it this week as well. The article on the Vanguard bond fund manager.
Exactly. So that was one of the things before we start clubbing and beating Jay Powell up. I was having another read of that, and it makes specific reference to is it Mr. Atterman? But he says he says it himself, is that of the 13,000 bonds that are held within the index that we track, we only hold about 7,000 of them. So to me, that sounds like an active fund. Is that not an active fund instead of a passive fund?
It's absolutely active. And by the way, those the 13,000 bonds that are in the index are out of 1.9 million securities that are listed bonds in the United States that are eligible for inclusion in that index. So it's like this is the thing that I loved in giant air quotes with an exclamation point and a red slash through it about the article was that it could not have laid out more clearly that these are active vehicles, and yet they are given dispensation. They are allowed to market themselves in a manner that is distinct and different from the behavior of how active funds are treated. The distribution story and the marketing story is really the underlying dynamic of Vanguard. And that really was the subject of my Substack this week. And it's again, that article could not have laid it any more bare how much influence these vehicles are having on markets. I actually agree that they're having a bigger impact in bonds than they are in equities, in part because the dynamics of liquidity are so radically different in bond markets than they are in equity markets. We do not have the equivalent of the New York Stock Exchange for bonds. They're not listed in the same way. They're not traded in the same way. There's not a bid-ask that is easily displayed alongside volume statistics, etc. And so the bond market is just the most extreme version of this, and yet it's actually the space where passive is growing the fastest. As they point out in the article, in the last decade, it's gone from about 10% of the market to north of 31% of the market. That sort of growth, like you can't even begin to articulate how important that type of influence is. And I've made reference to this elsewhere, and just again, loved in all the wrong terms the way that article so clearly laid it out if you read it properly. And the great irony, of course, is that the reporters don't get it. The regulators don't appear to fully appreciate and understand this. But this is just to put this in perspective, this is a bond fund that has, a couple $100 billion in it and is carrying $400 million in cash. It has no liquidity. It has to hit the market if it has to transact. And so again, thank you for flagging it. I'm glad you found it as impactful and obviously active as I do. But it's the other thing that I said in my Substack that I think is really important for people to appreciate is that Jack Bogle's, real innovation was highlighting that investors were being overcharged by large fund managers. And there's a very famous example of Max Heine handing over control of price funds to, I'm blanking on the name of the firm actually, but to Michael Price, Oppenheimer, I think it was. I'm blanking on it. It'll come to me in a second. Somebody can shout it out if they want. Where one of the key things that actually used to happen in the business was that they were partnerships. You would hand over asset management firms. It was presumed that the skill set resided within the management team themselves. There was no terminal value associated with the business. That changed radically with the public listing of Goldman Sachs and the IPOs of various asset managers over time. Today, the institutions and their distribution agreements, BlackRock, Vanguard, etc., are really the key asset. It no longer sits with the asset manager. That has changed the calculus of the industry in immeasurable ways. Most importantly, the way the industry was designed is the relatively high fees, and in many cases they were egregious. I just want to be very clear on this, but the relatively high fees encouraged new entrants into the asset management marketplace. It allowed people to get a footing under which they could begin to manage money and offer their unique insights and ideas. You were effectively subsidizing new entrants into the market, making it more competitive. Today, it's working in reverse, right? Fund companies are disappearing. The number of funds is shrinking. The number of issuers of funds is shrinking. And I've highlighted this, like the great irony. We've been incredibly fortunate at a firm like Simplify to have the support of investors, to have the support of clients and registered investment advisors who've allowed us to grow from, issuance to somewhere in the neighborhood of 1.7 billion today. Under that framework, right, it seems like we've been extraordinarily successful. I just have to emphasize that's one day of Vanguard's inflows, right? So for 2 years we've been working. We're in the top 30 issuers now, and we've been working for 2 years to get 1 day of Vanguard's inflows.
So about is that just a natural selection thing that these guys haven't? Kind of, because most of them are. Have they just not kept up? Have they not seen what you've seen and kind of? I mean, you've talked a lot with, in the past you've talked a lot with Wayne Hammerstein on podcasts and stuff that you've done together. That Wayne had this idea, and you kind of with it a bit to say that everything has to have this positive drift caused by passive.
Well, so just to be,
is it the fact that they kind of haven't kept up with what's happened and what's changed in the market?
So I think that's part of it, right? So that's part of the reason why so many people have heard my narrative at this point, and it continually shocks me, by the way, that not everybody has heard this story, and the resistance to it is extraordinary. Right, for very, very simple reasons, because the world is filled with the whinings and complaints of the world's smallest violins playing for active managers who are less potentially rich than they have been in the past versus the rest of the population, right? I'm going to be very clear. I understand how privileged my position is. I understand how fortunate I am to have had a skill set and the opportunities to participate and to make the money that I've made over my career. With that said, the awareness of the impact of passive is really has really only just begun in the last decade. And the academic support for the analysis of this really only began in 2020 with the publication of the Inelastic market hypothesis by Gabaix and Koijen, follow-on work by Valentin Haddad at UCLA, the work recently of Ji Lu, who's a PhD candidate at Stanford Graduate School of Business through what's called the Portfolio Channel. And so, this is the equivalent of being in 1953, where, the underlying characteristics of the market begin to be described under the initial work of Markowitz and others as having aspects that are, sorry, I'm getting some gas. having aspects that are tied to, random walk components and the efficient market hypothesis and modern portfolio theory, etc. We're actually living through a revolutionary time in our understanding of financial markets under those types of frameworks. The problem is that the institutions are already in place that support the existing narrative, right? So, the idea behind markets as we currently think about them is something along the lines of markets respond to information, right? I see a stock that is overvalued. Hello. I see a stock that is overvalued. I decide to sell it out of my portfolio. That selling minutely influences the behavior of that stock. Other people come to a similar conclusion, and slowly the price moves over time to reflect that information. Increasingly, we're recognizing that that's just not the way the markets work at all. That markets are actually quite inelastic. In other words, price changes a lot, relatively small changes in supply and demand. Sorry, I know there's going to be wind. I'm going to step back and hold on 1 second.
Yeah, no worries.
And so if that's actually true, that the markets are inelastic, and the evidence before this is increasingly incontrovertible, then the framework of quote-unquote passive doesn't make any sense, right? And so what you end up with is the equivalent of trying to think of the right language to use to describe this, but passive is not influencing things to cause them to instantaneously shift, right? It's not like Vanguard decides to buy and Apple immediately goes to 1 million. It's almost more like a cumulative weight gain, right? So I gain an ounce every day over the course of the year. By the end of the year, I'm fat, right? By the end of 10 years, I'm really fat. And that cumulative process has slowly played out in a very David Foster Wallace, this is water type framework, right? We don't realize that it's happening, and yet it's been lifting us underneath. And you see that in the behavior of markets where valuations have continually risen, not for every security in a consistent fashion, but for the market in total, and particularly those at the leading edge of the market. There's other components that are contributing there that are causing the behaviors that we're seeing. And when you actually have that lift, that drift component, it actually means that all of the models break down. In particular, the calculation of alpha, right, which is what's used to assess the value of active management, has a very unique characteristic to it. So if you think about the CAPM formula, right, Y equals MX plus B, the behavior of the portfolio, Y, is equal to its beta times X, the performance of the market, plus some residual amount, right, what's called the intercept in a linear equation. That residual amount is effectively the skill of the manager for that portfolio. It's what we call alpha, right? Mm-hmm. If you try to use a linear equation, Y equals MX plus B, to describe a market that has this curvature, right, that continuous 1 ounce a day weight gain, it's going to become increasingly inaccurate. But more importantly, if you just think about the slope of that line as it begins to curve over time, and as I measure the equation on a continuous rolling basis, right, time 1, time 2, time 3, that intercept is mechanically forced down, right? The slope rises, the intercept is forced down. That shows up as increasingly negative alpha for active managers, which paradoxically we all interpret as, oh my gosh, these guys are getting worse and worse and worse at their job. Right? And therefore we choose to fire them. Well, when we fire them, we're increasing the passive share. We're making it worse and worse and worse and worse. Right? That's what's different this time around. And unfortunately, the way this resolves itself is in a tragedy of the commons type framework, in which it manifests exactly like the trade I'm well known for, the XIV. It manifests itself in a when outflows actually exceed, the entire system corrects violently, and all of those gains are regurgitated at some point in the future. But this is now, the John Maynard Keynes line, like in the long run, we're all dead. By the time we get there, the behaviors of the market have shifted so radically that it really doesn't resemble what we started with. And we run an increased risk that we've broken the system in the process of applying a very flawed model to the way it's supposed to work.
So in terms of like stocks, when I've been listening to your work, I've kind of got this hodler thought process in my head that Vanguard and everyone else are just slowly just hodling shares of all these stocks. How does that differ? How does that differ with bonds? Does it differ?
So it doesn't differ all that much with bonds. The difference is that the way that you measure market impact, and this is the work of J.P. Bouchaud, Bouchaud, who wrote a variant or a further interpretation of Gabaix and Koijen's The Inelastic Market Hypothesis. And the reason I say all these things is because I want people to download these and read them so they can actually understand them. The math is challenging, but it's certainly not inaccessible. And others have written summaries of them that are fantastic. And once you know what you're looking for, you can find all this stuff. And I just want to continually emphasize that, like, my actual contributions here are pretty damn small. The best thing I can actually say is that I narrate it better than other people do. But in the bond market, so the way that you measure market impact is that the impact of a trade is a function of the size of the trade relative to the volume and volatility of that trade. And the reason why that works is because of the way market making activities are actually conducted. And this applies to Bitcoin, and it applies. Bouchaud, I actually posted in the thread that is linked in my Substack. I posted a link to one of his presentations that is beautiful and fantastic in its simplicity and helping people understand this stuff. It works across Bitcoin, it works across equity markets, it works across fixed income markets, etc. This relationship, where what you're looking at is the size of the trade relative to the liquidity and volatility of the underlying instrument. The volume and volatility is how you measure market impact. So when you have products like bonds that don't trade very frequently, in other words, their volume and liquidity relative to their market capitalization or their issuance size is quite low, and their volatility is exceptionally small, the impact becomes extremely high. Right, to the effect that really the market making operations in bonds are radically different in many ways than the equity markets. Relatively small changes and that hodling behavior means that prices can move a lot. Now, the flip side of that, of course, is that you very rarely trade bonds, and bonds, unlike equities, have their own self-liquidating events called maturity. So the bond matures, the issuer issues a new bond, rinse and repeat, right? You're not moving the same bond as much, but when you do transact, when new money comes in, etc., you can exacerbate those drift dynamics. It also, in the bond market, carries unique characteristics because the behavior of interest rate policies can influence that dynamic. It actually causes if you run through it mechanically, and I actually just shared some of this work with some of our simplified clients, it mechanically causes an increase in duration or interest rate sensitivity in these indices that is not dissimilar to rising valuations that occurs within equity markets. So a lot of people would look at the recent correction in bond prices and say, well, that's a function of people just being stupid in response to super low interest rates. What idiot would want to buy them? Well, that article tells you who. Right? I mean, there is no analysis of duration. There is no assessment of federal interest rate policy, right? We all want to blame Silicon Valley Bank, and yet Vanguard is out there to help everyone.
So in this way, this might be a stupid question. So much in the same way that you say that Jay Powell has made any number of mistakes, what's stopping this guy at Vanguard making an equally large mistake, but he's hidden within inside an institution that's private, well, publicly traded? But
I don't think there is actually any meaningful distinction between the two. I would just emphasize that the interesting characteristic, and I use interesting in air quotes, is that he's not at all visible. Right? We assume that they're passive, and I just I explicitly reference this in my Substack, saying he's pulled a Kaiser Soze, right? And it's not him; it's the organization, right? But Vanguard has convinced everyone, including Bob Pisani. There's a link to an interview I did with Bob Pisani, where you can physically hear Bob Pisani recoil at my suggestion that he was being sold by Jack Bogle. Right? Jack Bogle would never sell me. Jack Bogle was a saint. Bullshit. Jack Bogle marketed the hell out of everything. He was Jordan Belfort.
It's not ironic to so some of the podcasts on Blockworks, obviously around all the banking crisis and everything else, it literally, like, obviously lol, it literally made me laugh out loud when the interviewer would say, right, we're just going to quickly cut to a word from our sponsor, and it's so the sponsor for the interview, which was about capital flight from banks, was from a company that will happily help you try and transfer your money outside of the bank to put into 5% short-term treasury.
Right, money market funds. Absolutely.
Exactly.
Yeah, no, I mean, you're making me laugh thinking about it, because I can absolutely see that happening. It's hysterical.
But does that? So do we get what we deserve? Like, is the fact that the interviewer for that piece didn't pick up on what was actually being said, and are they choosing to ignore it, or do people just not really understand it?
Look, there's some things, right, and I'll just say it bluntly, because unfortunately that's the only way I know how to say things. It's not that we get what we deserve, right? It's that we're actually so terrified of many truths that we ignore them, right? It's just, there's many situations in life where, like, something that is being presented to you can't quite be true, and yet to get along and go along, you're willing to let it slide, right? And that ranges from organized religion, like, do you actually believe there's a man in the sky? Do you actually believe that in 7 days the earth was created? Do you actually believe that the Quran are certain verses that were transmitted, etc.? Like, I don't care. I just want to be very clear. I'm not actually picking on that to, like, try to emphasize any of those individual religions or choices. But we all know that things should not be taken literally in many situations, and yet the language that we allow and that we facilitate within our discussions, and this can go from wokeness to MAGA, are that we're in polite company. We don't challenge it. And so, again, that's what Bob Pisani, if you listen to that interview, like, Bob Pisani's like, dude, you just compared Cathie Wood and Jack Bogle? Like, you're a heretic. You should be burned at the cross, right? Burned at the stake, I'm sorry.
Yeah.
And unfortunately it's true. They're one and the same. They're both prosecuting an ideology that is designed to lead to outperformance. It's just one's cloaked in, I'm doing it to save the world, and the other one's cloaked in, we're doing it to invest in disruptive innovation, and and by the way, God selected me to do this, right? Like, it's all the same nonsense. And to be very clear, I fully understand that there's an element of me sharing this information that's designed to market my services, right? Like, I'd be an idiot if I wasn't doing that. So, you can take all this, you can throw it away, and you can say, all right, that guy's pitching his book. Yes, of course I'm pitching my book, because it's what I believe.
So on that note then, if everyone's trying to measure curves in a linear fashion, how then does non-linear, so how do options impact that?
So
Do they just exacerbate
yeah,
everything?
absolutely, right? Because if you think about the way that we create options, and options are actually a really interesting vehicle, right? So remember that when I buy a share of stock or I sell a share of stock, for the most part, what they're doing is they're crossing a position, right? So I show up to buy Apple shares, you show up to sell Apple shares. The objective is to very, very clearly create a bid-ask spread that we're able to cross, right? When we do that, there's no need to actually transact between anyone other than the two of us, and that's what market makers do. Options work slightly differently. When I show up to buy a call option on Apple with a certain expiry at a certain strike, the odds of any individual being on the other side of that trade are effectively slim and none. And so when you have that type of situation, the way that the systems actually work in options markets is that we facilitate a transaction using what's called risk neutral arbitrage, or taking advantage of what's called put call parity. I can synthetically create that option and hedge out my book by delta hedging the exposure, right? So I buy a 50 delta option, a 50 delta call option. The market maker writes that to me. In other words, sells me that naked. They then go out, and this is actually done simultaneously to protect themselves. They then go out and buy 0.5 shares of the underlying security, right? Those 0.5 shares influence the price of the market. And as the market becomes increasingly inelastic, it takes smaller and smaller quantities of shares to cause prices to change. The growth of passive raises the inelasticity, again, referring back to Valentin Haddad's work, raises the inelasticity of the market, meaning that hedging impact becomes larger and larger and larger. And you can create these feedback loops that we call meme stocks. So all of this stuff kind of plays together. If you're going to take advantage of these phenomenon, one of the ways that you can do so is by recognizing that options themselves improperly price those characteristics. Now, in an individual security, the way dealers deal with that is that they crank up implied volatility. This is why GameStop implied vol went to 1,000, right? It's also facilitated by idiots on the Robinhood platform who are buying options without actually understanding what implied volatility is. I actually signed up for Robinhood and looked at the information that was being transferred to people. And if you're on the Robinhood platform, you don't even get an implied volatility metric. When they talk about the cheapest option, they're literally talking about what's the lowest priced option, which tends to have the highest level of implied volatility because it's sitting so far out of the market, right? So, part of the nonsense that happened in 2020 and 2021 was platforms that were selling, ice cream to Eskimos, effectively, and not telling them it had sugar content. So
you can tell you're on you can tell you've been on your keto kick.
Yes, exactly. I'm fantasizing about these things. But that is, so that's kind of sitting at the core of it. And if I go out and I buy that very far out of the money option, that super low delta option, and it turns out actually that the stock is more inelastic than I thought, then I drive the price of the option up, right? The delta hedge ratio has now risen. Now I have to buy more shares, which drives more delta. Ben Eifert did a phenomenal thread on this a long time ago. I wish I could pull it back up, and I wish Ben was a more active participant on Twitter. But it's a perfect illustration of that type of dynamic.
So to take it back to the bond part at the beginning of the conversation, when you talked about 2022, the price action in equities being driven by the fact that bonds sold off so much, and that all the 60-40 and target date funds had to sell their equities to rebalance.
Yes. So this is what's called the portfolio rebalance channel. Again, there's a flourishing academic body of literature that's building up around this. Hannah Lustig wrote the first work on this, I believe it was 2012. Jonathan Parker meaningfully expanded it in early 2020. Some of Hannah's PhD students, I was mentioning Xi Lu, for example, have further expanded on this, and I can post it and discuss it in various things, but you can just mechanically see how this works. If I run a portfolio that is systematically rebalancing to 50-50 bonds and equities, and an external actor, effectively a deus ex machina, shows up and says, I'm going to create conditions under which the non-arbitrage price for bonds has to fall, which is what happens when the Federal Reserve hikes interest rates, right? It's a policy-driven component. That mechanically causes bonds to fall in price. Now, if I have a portfolio that has to rebalance mechanically to 50-50 bonds and equities, and bonds have had an external actor drop the price of those bonds, what do I have to do? I have to sell equities and buy bonds to get my portfolio back to 50-50. That is exactly the behavior that we saw in 2022. It is far better than any other explanation for what actually transpired in 2022. Is that we just mechanically saw markets forced to respond to interest rate hikes. And what began to happen is, as the Fed's interest rate hikes have a smaller individual impact, right? So as I hike interest rates from 0 to 50, that has a big impact. As I hike from 50 to 100, well, that has a big impact, but less. 100 to 150, etc. If I keep doing this process, and again, remember, he started at 75 and then he lowered it to 25, right? And by the time you get to the point that the interest rate sensitivity of these securities has meaningfully begun to fall, you're actually creating conditions under which that can begin to ameliorate itself. The problem becomes somewhat self-correcting, and the markets can begin to rally, which is exactly what we saw towards the tail end of last year. Now, I just want to be clear. There was Robin Wigglesworth is now a friend, but there was an article written, I think, back in 2020 called "The Theory of Everything" that basically challenged my interpretation of it and said, these guys think that the flows of passive are absolutely everything. That is not the case. I just want to be really, really clear. I don't think that this portfolio rebalance channel explains absolutely everything that's going on, but I think it explains far more of what we're actually seeing than the idea of a bunch of green eye shade wearing accountants sitting over their HP 12Cs and furiously calculating what the present value of Apple shares are, right? In part because those participants no longer are actually getting the flows. If anything, and it's horribly offensive again, I apologize to those in the audience who happen to be in the same industry as me. Being an active manager is basically the easiest way to say, I am a loser, right? You are being fired. The people that you hang out with are dying. Your clients are redeeming from you. And all of your hard work is basically running in reverse. You pick great stocks, and then people fire you, and you're forced to sell them, causing those stocks to go down. When those stocks go down, your portfolios underperform, more people fire you or die, right? Probably horrified by the results of your active management process, and therefore they just keel over. So this is it's a doom loop. We've created the perfect active management killing machine.
So one of the questions I threw out in reply to the piece with Eric was the thing that never happened, kind of happened 3 times in the last 18 months, which was basically LME saying, yeah, thanks, but no thanks. We're going to stop all your trades and not transact them because actually you just made those trades at the wrong prices. Then you had Luna, which done Luna type things. And now you've got BREIT that have gated redemptions. Could you see a scenario where these funds, whether it's on the bond side or the equity side, we're just told, yeah, okay, you can have your money back, but only in 5% cuts once every 3 months?
So I don't want to hyperventilate on this. Right? So first of all, the 3 things that you mentioned, things like that have all happened before. Right, Third Avenue funds is gated, and other funds, many funds gated in 2008, similar to the B-REIT type dynamics. Luna is an algorithmic breakdown that's not at all dissimilar from either the algorithm run amok with night trading that caused the bankruptcy of night trading, or the XIV, candidly, where effectively the liquidity dynamics under normal conditions exceed the parameters of the model because it hasn't been properly modeled in terms of a self-reflexive system. The dynamics of most things that we see have happened before. They may not have happened in markets that we're used to thinking about them in those terms, right? Like we all experienced toilet paper stockouts in 2020, right? Sounds fundamentally insane. If it were 2018, you're like, man, you know what you're really going to want? You're going to buy a Japanese toilet because there is not going to be any toilet paper. People would have looked at you like you were clinically insane, right? By 2020, they would have looked at you like you were a prophet. And by 2022, they'd be like, all right, yeah, you're kind of crazy again if you keep saying that this is the underlying case. But I assure you that sales of Japanese toilets have exploded. Not the toilets exploding, the sales. So the point that I would make on it is that yes, things will happen that have never happened before. I actually think it is almost a certainty that we will be faced with a gating of funds, and we will be faced with market closures. And again, this has happened, right? The New York Stock Exchange closed effectively from 1914, I think, until parts of for 6 or 7 months in 1914. And eventually reopened as things, quote unquote, settled down. But this has happened before, and I think there's no reason to expect it won't happen again. The characteristics of vehicles like Vanguard's bond fund, where you're carrying $200+ billion in assets against $500 million of liquidity, bond funds have an interesting characteristic where they create their own liquidity through the maturation of securities, etc. And so theoretically, like, it's really hard to actually get it's really hard to get a situation in which bond funds become completely illiquid and incapable of meeting redemptions. REITs are the same way, right? The refinancings and flows of capital coming in occur all the time. You know what else rarely happens where you see that sort of run on liquidity where the withdrawals exceed the repayments of loans and the natural maturation stuff? Banks. It's not that often that people show up and ask for $42 billion in a single day, right? That happened, and it was totally unprecedented. And now what happens if somebody shows up and says, you know what, we'd really like $42 billion from Vanguard? Right now, their business model is probably better, right? There's lots and lots of small, tiny individual customers as compared to various Silicon Valley venture capitalists. So all these things are, I think, very hard for people to see, but the dynamics of the system are identical.
So does this get into the downstream effects of rate hikes? And
so it does, and this is part of the great irony, right? There's actually an interaction that I had that I'm quite embarrassed by, actually, where Jim Walker and I were kind of pissing at each other the other day. In the private conversation that occurs alongside this, and I want to emphasize that, Jim and I and many of the people that you see me interact with, whose name is escaping me right now, actually highlighted exactly these issues at Jackson Hole in terms of the vulnerability of the banking system to rapid interest rate hikes and tightening of financial conditions associated with quantitative tightening, and cautioned that the Fed should proceed very cautiously, right, under this framework. The paper is out there. It's got Rajan's name on it. I'd be happy to link it when I'm not driving. But this is almost exactly the point. Powell ignored it. Right? Instead, he chose to pursue the path of, hey, Volcker did it in 1979, 1980, 1981, without really understanding the risks that he was exposing the system to, not at all being clear about what his true objectives were. Now, again, whether those objectives were a fundamental misunderstanding of the role of interest rates in affecting inflation, or whether those intentions were undeclared, as I pointed out in the Macrovoices, is actually irrelevant to me, because paradoxically it's more problematic if I've got an unelected bureaucrat who has lied to Congress about his intentions, rather than simply being incompetent, right? Incompetence I'll forgive. Venality I will not.
So I will admit. So one, of course, you can tell by my voice, I'm British, so I don't watch the Fed anyway. But like,
consider yourself blessed.
So what specifically did he lie about?
So his point was, Powell never articulated, my objective is to end financial speculation, right? My objective is to end the put. That was never discussed. It was, our objective is to target inflation.
Mm-hmm.
Right? Those are two very, very different components.
So when he was transitory.
So that's what leads me. I mean, I just want to be very clear, right? My general perspective, and I've used this quote many times, and it's a paraphrasing of Hanlon's razor: never substitute conspiracy when incompetence will suffice. Which is why I think Powell's incompetent. Like, I see nothing in his training or his background or his awareness that would lead him to the nuanced understanding of the dynamics of inflation that have driven the outcome that we've seen. And candidly, you see it on FinTwit, etc., where, it's really hard to say to people, inflation is always and everywhere a combination of factors. All right. Thank you very much, Mr. Green. That's an extremely useful and non-pithy statement. Right. But it is, right? And it actually is a combination of factors, and there are feedback loops associated with it. And one of the incredible things that actually happens when we go through these events, and again, it's things like the academic flourishing that I was describing around an understanding of the behavior of markets that's occurring. When events occur that haven't happened before, extraordinary analysis and research emerges. And there's just been some incredible stuff. I mean, Robert Hall's paper evaluating the dynamics of the role of volatility in price setting that came out in the last year, it really just in the last couple of months actually, it's just an astonishing paper in helping people understand the dynamics of price formation within markets, right? We just haven't had the lab, we haven't had the empirical data that shows this stuff, but it makes it very, very clear, right? It's not that corporations suddenly got greedy, it's that the volatility that emerged actually created the cover for price increases, in which they could simply say to their customers, right? Yes, my customers buy it. Right? There's a cost associated. You walk into your local restaurant, right? And if the menu changes randomly every day, eventually you're like, "It's me to eat." But for an environment of very rapid price changes for everything else in the economy, you cut them some slack, and you're like, it's not their fault. Right? And that's exactly what's happened. It's not the cost of ingredients or the cost of doing business at Coca-Cola or any of these companies have necessitated the price increases that we've seen. Right? Their profit margins tell you that's not the case. But what has happened is that the uncertainty and the instability of prices has created the cover for this. Enhanced in an environment in which we've allowed antitrust, and monopolistic activities and consolidation to go unchallenged for decades under the argument that the free market should be determining these things. So, all this stuff is flourishing and happening behind the background. We got this dullard who's sitting there at the head of the Fed who's like, I'm going to behave just like this, super tall Paul from 1979, without actually understanding how dumb that is.
So let me march in with my shield and try and protect Jay.
Oh, please do.
His staff's job to be finding those things and bringing this up to him. Is he choosing just to ignore it? Are they?
He actually explicitly told you that in this last conference. The staff has their projections. They don't have to be the same as ours. And in fact, We think it's wonderful that they have their own opinions. We don't need to follow them. That's literally exactly what he said.
All right then. I won't ride in with my shield and protect him then. Okay.
No, I like it when people ride in with their shields. That's what dragons are there for, to melt the shield.
Yeah. I don't know if you listen to Jordan Peterson, but I don't like his analogy of Bitcoin and gold and the dragon in the cave, because I think Bitcoin and gold are the dragon and not the gold in the cave. But that's another thing. But yeah.
Yeah, I know. You and I disagree on that, and I actually have. Hopefully this is clear. I very much understand your perspective. I just disagree with it.
Mm. So the other question I had was around the TGA.
Yes.
Mechanical function, because as you're saying, Jay, as you've just said, Jay chose not to follow his staff's forecasts and projections. So as soon as I heard, I can't remember is it the Fed guy 12?
Joseph Wang. Yeah.
Yeah. So when he's talking about the TGA and everything, the debt ceiling, well, however that sorts itself out, and the TGA has to be refilled. Immediately when I first heard that, the first thing that came into my head, and this might be completely off, was, well, they also said that they had to refill the SBR as well, and that we would do it when the price got to whatever the level was, 62 or whatever. We were going to refill the SBR.
Yeah. And 70 was the level, but yeah, they
70.
Didn't.
Okay, so and they didn't do it. So
yeah,
just like everything else that's changed most recently, like when people say they will have to refill the TGA, do they actually have to, or is this something that might not be done?
No, it's a great question, and actually, your question on that, I think, is actually a very, very valuable one. I actually think, so first of all, they don't, right? So remember, the growth of the TGA is actually a phenomenon that emerged in the aftermath of the debt ceiling crisis in 2011. It was effectively the Treasury's way of protecting itself. Okay, so the emergence of the sizable TGA, effectively the Treasury protecting itself from debt ceilings, emerged in the aftermath of the last financial crisis, or the last debt ceiling crisis. And I broadly think, actually, that the biggest issue we face here is I see no reason to believe that Yellen actually fully understands the liquidity implications of the TGA. I think she is remarkably tied to models that actually don't even have banking within them. And so I do think that this is another example of, don't substitute conspiracy where incompetence will suffice.
Okay. So does this... Yeah, so this brings us back to employment, I guess, because she's obviously using a lot of labor models, right?
Yeah.
So does this all hinge on employment and whether Jay Powell's killed the economy?
I think a lot of these components are tied to that. I think there's also, though, I think one of the challenges that I try to highlight in the stuff that I put out is, most models, and this is where you'll hear me, sound like an Austrian critiquing Keynesianism, right? So Keynesianism tends to operate from the system of aggregates, right? The C plus I plus G plus X minus IM model of the market and the economy, in which it's presumed that there's no difference between government spending and investment spending and private sector and public sector and all that sort of fun stuff, right? And individual actor behaviors, etc., right? To me, that's insane. It's completely, almost clinically insane, and I cringe when I hear these super simplistic, analogies that are used by individuals like John Maynard Keynes to say it doesn't matter if I, hire people to dig a hole and then hire somebody else to fill it back in, right? Well, that is a fundamentally flawed model of the economy because it fails to consider the aspect of time and the genuine scarcity of resources that accompany a world in which the arrow of time only moves in one direction. If I hire somebody to dig a hole and then hire somebody to fill it back in, yes, I have technically engendered economic activity, but I have squandered human capability and time.
Yeah.
And that's where the Hayekian framework, the Austrian framework of saying, no, there's unintended consequences, right? If the government bids up the price of hiring people to dig in holes and then fill them back in again, that means that there's somebody who doesn't get a job at McDonald's to make burgers that can actually be used to feed hungry people, right? Like, there's the unintended consequences component of it. And so the Austrians are 100% correct on that. But the idea that that's somehow always the governing characteristic, right? That the limiting factor within the system is always the integrity of money, is also flawed.
Yeah.
Right? It's just like sometimes skipping a meal is really good for you, right? Intermittent fasting can be one of the healthiest things you do for your body. You know what's also really healthy? Eating. Right? And so, like, again, nuance is available on sale because nobody wants it.
Because it's okay, because we can just buy a passive fund and we can just extract alpha from the market.
100%, right? And, okay, the solution is everybody goes out and buy it. Now, John Bogle himself acknowledged, and this is part of the presentations that I give on this, right? John Bogle himself acknowledged that was untrue, right? His own words. If everybody indexed, the only words would be chaos, catastrophe, the markets would fail. Right? Now, the difference was that John ran it under static models in which he said, okay, at what level of passive does that price setting capability break down? Right? And the answer is actually, and I've run these analysis as well, which is why I can speak to the work that he's done. Or was done for him, just to be very clear. John was not building agent-based models or anything else. The answer is, it's somewhere around 80 to 90% passive. The price-setting models break down, and you can very mechanically understand why that is. Because the only sourcing of liquidity that occurs from passive in a static framework is from the active managers, right? If passive is carrying no cash, and active is the source of liquidity, and passive tries to sell, there has to be enough cash in the active manager pockets in order to transact. Right? Now, imagine a market in which it is 90% passive. 90% passive. If passive wants to sell 1%, right, by definition, that means they have to take 0.9% out of the market in cash. That means that the remaining 10% active managers have to, at minimum, be carrying 10% cash.
Yeah.
Right? But that's not actually going to happen. Because would I give all my cash up for a no real change in price dynamic? Of course not. That'd be ridiculous. Right? So what happens in those models is that you discover you create a cascade around those levels between 80 and 90%, in which the system breaks when passive tries to transact. The problem with John's model was that they were using static frameworks. They failed to consider the transition from 0% passive to 90% passive. And in those transitions, more than 100% of the flows have to be passive. And so the price setting mechanism breaks down much, much earlier than their models assumed.
So is this just because they have no one, because the impact that they're going to have will slowly reduce the people that they can actually transact with?
Yes, we're all familiar with the predator-prey dynamics, right? You can think about the dynamics of, if there's too many rabbits and not enough coyotes, right? What happens? The grasses eventually die. They eat all the grasses up, and then the population collapses. That's mechanically what's happening within the active manager community, right? And by the way, think, imagine a world in which you evaluated the success of coyotes in terms of their control of the rabbit population, and then you continually release rabbits into the population. You're like, man, those coyotes aren't doing their jobs. We should probably get rid of the coyotes because they're not very good at it. What's going to happen to the rabbit population? It's going to accelerate and then collapse. And that's exactly the model that I'm articulating.
So I can't remember when you did the I don't know if it was the first, but you gave a presentation. You had a full slideshow and everything that showed the impact of passive. And although you've said, like in this calculation, if passive gets to 90%, but where is the point that it becomes?
Yeah, no. It's a great question, and the answer is it's not a point; it's a cloud, right? It's a cloud of uncertainty, and that's because ultimately markets, right? So markets are stochastic in their framework, right? I don't know what's going to cause the actual event in the same way I did not know what was actually going to cause the collapse of XIV. Right? I couldn't say it's going to be on, Tuesday, January 23rd, right? Like, you just can't do that. But what you can do is you actually can effectively turn around and say, okay, what are the feedback loops? What's creating this? Where does the point of uncertainty become all-encompassing, et cetera? And what I've continually said to people is beyond 50% passive, the system actually starts to spin out of control under a stochastic framework in which the probabilities of you successfully executing a trade become increasingly less likely. Right, and so everything starts to look like a GameStop type dynamic, where what was really happening with GameStop was the dominance of hedging flows, and short covering flows, etc., overwhelmed the system. Right, there was no fundamental analysis that was sitting there saying, oh gosh, I really think that there's this fantastic new business model for GameStop. The press, people create those narratives, and somewhere out there's Roaring Kitty Part 2 who's saying, now that they have all this cash, things are great. But if you go back and you read my tweets from that time period, in response to very simple analysis, this is the easiest thing in the world. You should just be betting that this thing is going to go straight to zero. Again, this is like the Soros reflexivity type dynamics, right? What does the explosion in price in GameStop create? It creates the opportunity for GameStop to issue shares that raises the cash balance at GameStop and suddenly creates conditions under which, well, maybe it's not going to go to zero quite that fast, right? What else happens? Who became the largest buyer of GameStop? And do you actually know who the largest buyer of GameStop was?
I guess Vanguard.
It was Vanguard. And the answer was because at one point, GameStop became the largest stock within the Russell 2000 index, and therefore each dollar that went into the very hyper-rational Vanguard was actually, hyper-rational again in air quotes, was actually subsidizing the insanity around GameStop. Michael Burry sold his GameStop. He did phenomenal analysis. Hats off to him for nailing it twice, right? He did phenomenal analysis around this, understood the mechanics of what could happen under these conditions, understood that these were overly shorted positions by overly confident investors, etc. And so he correctly nailed that. But ironically, he was facilitated by the players like Vanguard, because when the price is mooning, to steal the terminology of the day, Michael Burry does what? He sells his shares into that because he says the realization of the opportunity has been created. There is no further higher return associated with it. Meanwhile, the pukes over at Vanguard are saying, and not saying, this is just mechanical, oh gosh, look, it's gone up a lot in price. We should buy more relative to each dollar that comes in now.
So Vanguard was Michael Burry's exit liquidity.
You got it. That's exactly right.
So Vanguard saved the day.
For Michael Burry, yes.
For Michael Burry, not for anyone else. Yeah. So there's a couple of people have asked questions. Are you happy to? I've taken up a lot of your time. Are you happy to take a couple of questions?
Yeah, I can take questions for about 10 minutes.
Okay, that's awesome. Thank you. Let me just see if these buttons work. There we go, Charles. Do you want to ask a question?
Yeah. So I joined sort of halfway, I think, on this. So apologies if this has been covered. But who do you think wins politically with the position that the Fed's in right now? I think we're in agreement that the Fed is, sort of. I'm not sure if I'll take it as far as lying, like you said earlier, but they clearly are being a little disingenuous with their communication. So do you think that one, the Fed has the political power. Let's assume inflation, continues at a super high handle. Do they actually have the political backing to continue pursuing this, or you mentioned you were talking about the TGA a little bit ago. Like, does Yellen win out in a way by? I don't think she's as committed to this inflation sort of boogeyman as Powell seems to be, right? So, just I guess broadly, who do you think politically is going to win out in this sort of game of chicken that's going on right now?
So, ironically, I don't think it's actually a game of chicken. I think, by and large, the Treasury and Congress have used the Fed as both a scapegoat for causing inflation rather than acknowledging that they themselves drove the inflation through the fiscal stimulus, because that would be politically unpopular, because then the solution is we need to raise taxes. So instead, they put it at the foot of the Fed, and the Fed, for some bizarre reason, decided not to push back. Right? I think this is the evidence of how weak Jay Powell is as a man. Because the correct response is, no, we didn't cause this, you caused this. And, here's the evidence behind it. Here's your failure to enforce antitrust. Here's your outrageous fiscal stimulus, right, combined with an unwillingness to raise taxes, the facilitation of fraud under things like PPP loans, and now the employee retention credits, unemployment fraud, the list goes on and on. The inability to push back in that framework has actually created the perception that this is the fault of the Fed. The Fed has now taken actions that are going to broadly lead to seriously adverse conditions. And so the loser, of course, is Jay Powell, who, in my opinion, will go down in history as the worst Fed chair, replacing Paul Volcker. In my books, probably I don't know how this is truly going to play out in history books, but my sense is that unlike the reconciliation with history, that the heroism perception that Paul Volcker has that he did not have at the time, that is a byproduct of the relative success of the 1980s. And most people forget that he got fired, right? And by the end of the 1980s, he effectively rage quit the Fed because nobody would listen to his ridiculousness anymore. And of course now he's redeemed, because who doesn't like a cigar chomping 6'9" guy? So I think Jay Powell loses. And interestingly enough, even the defenders of Jay Powell are acknowledging that this is going to be the case. Now the problem is that in losing this battle, it's not so much that I'm worried about inflation coming roaring back because the Fed cuts interest rates, or the dollar collapsing because the Fed cuts interest rates. If anything, I actually think it's going to be the reverse. I think that he's created the perception that the right answer is going to be the AOC's Stephanie Kelton MMT type framework, in which is presumed, no, we have to do something.
I was afraid you were
going to end up with unfortunately, I think that's the direction it's going.
What do you, if I could ask a quick follow-up, and I'll be quicker in my question this time, what do you think is the biggest political risk to the Fed when they lose this battle? However they lose it, it sounds like you're convinced that they will lose it. There's all these, the $1 trillion coin and all these kinds of not paying the Fed interest on the securities they own, whatever. Like, what do you think is the biggest risk there?
So to be really clear, actually, I'm not scared of the $1 trillion coin in its reality. I'm scared of the implications of the $1 trillion coin in its perception that it removes the role or need for taxation, right? And so, people who are familiar with MMT will understand my statement that taxation is not actually the source of revenue for the federal government. They could theoretically print as many $1 trillion coins as they want and distribute as many dollars as they want, right? The problem is that it's like equity issuance. We think about all these things as debt because we're thinking from the perspective of a household. What you're really holding in your hand when you hold a dollar bill is equity in the United States. And if I continually overissue equity, guess what happens? My ability to pay dividends collapses. My ability to actually project a strong and powerful security that I can use for compensating employees, that I can use for making acquisitions, making strategic investments, etc., that all disappears. And so that's what the collapse of the dollar actually means. What causes a collapse in a currency is your inability to tax to soak up that liquidity, your inability to issue debt that causes people to say, you know what, I actually would find it valuable to receive that currency in the future, right? If they become convinced that your objective is to issue the currency to pay for things, as compared to make the productive investments and encourage the private sector development that actually does create those productive outcomes and creates the potential for future income generation and taxation, then the currency collapses. And unfortunately, like, given every stupid policy decision we've made up to this point, it does feel like that's the direction we're headed.
Well, it's an unhappy note, but thank you for answering my question. Thanks for doing the space.
So I've got one more question from my boy, Mitchell Krause, who said you got into a discussion at Hedge Eye Live, but you got cut off by another question. He asked how you believe the impact of the TGA when combined with passive dynamic plays out. I believe you started to discuss it at Hedge Eye Live.
Yeah, so I mean, really quickly, the TGA will soak liquidity. The refilling of the TGA will suck liquidity out of the system. We saw this in 2011. It caused a rally in treasuries. It caused a collapse or a fall in financial assets. You can just mechanically think about it. If I suck liquidity out of the system, what I have to do, I have to offer extra compensation for taking risk, right? We call that a risk premium.
Yeah.
I think that combined with the shrinking of the, in MMT frame, right? And I just want to emphasize, like, MMT in my model is descriptive. It tells you the way the system works. I'm not saying, you should use MMT for job guarantees or job banks or anything else. From a policy standpoint, we can discuss all those other components. We're simultaneously seeing a collapse of what I would describe as the horizontal money, right? So the willingness to extend credit is also falling. That's what we're seeing in the senior loan officer surveys, the tightness of credit availability to small businesses from the NFIB, the general sense that, things are getting harder, right? All those things suggest that what we're looking at is an incredible tightness of liquidity that creates a momentary surge in the value of the dollar. It's the next part of that causes, the response to that causes the collapse in the dollar. And so, I've had many conversations with people where I've highlighted, look, the next stage in this is that the dollar, maybe not traded versus the euro. I candidly don't have a super strong opinion on that in the Stan Druckenmiller framework. But your expectation should be that it becomes harder to get dollars to put in your pocket. And when dollars become harder to put in your pocket, that in turn creates conditions under which, the risk premiums need to rise, financial assets fall. Many segments of our economy have actually relied on the continued provision of credit, zombie credit, zombie firms, for example, commercial real estate, etc. If that credit disappears, you're likely to see job losses. Those job losses are increasingly happening at the same time that we're introducing a shock to productivity in the white-collar workforce. We call that ChatGPT or AI or LLM or however you want to think about it. All of those dynamics suggest that the next stage in the process is that people start to lose jobs. Those loss of jobs means reduced flows into things like 401ks and passive. And all else being equal, that suggests that the system could actually hit a stress point earlier than you otherwise would think. I don't know the answer, just to be really clear. But like so many other systems, I just want to emphasize, like, this is Ponzi-esque in its construction. Remember that withdrawals from financial markets are a function of the level of financial assets, whereas contributions are a function of incomes. If I have a system in which the asset level rises relative to the incomes, in other words, things become increasingly unaffordable, each hour of my labor buys less of the S&P 500, that system eventually becomes unstable. The withdrawals exceed the contributions. And when you introduce a vector like the growth of passive into that, and you recognize that the continual passive share gain means that you've actually had a continuous imbalance between money going into passive and money coming out of passive, it suggests that the system can unwind violently when those flows reverse. Right, and again, like I just give a really simple example. The size of the Vanguard, bond index the bond fund that I highlighted is one of many bond funds managed by this guy Josh Brickman, I think his name was again, totaling up to $1 trillion. Imagine he has a 10% withdrawal, right? I mean, Silicon Valley Bank had 25% of its deposits try to leave overnight. What happens if that happens to Vanguard? There is no liquidity in the system. It just can't handle it, and so the system has to stop.
So in this scenario, if we get the kind of so the most telegraphed recession, but if we get the kind of second leg down, just the same as you had falling bonds last year, causing a rebalance effect impacting the equity market. So now if we get that second leg down, that's going to bring it, and that will be the test, won't it? They'll have to rebalance the other way, where they'll have to sell bonds to rebalance into stocks.
Yes, although it could work in reverse, right? So if the Fed cuts interest rates and cuts them fast, bonds go up in value. I have to sell bonds, buy equities, right? If it happens slowly, which is unfortunately what I think is going to happen, because Jay is more interested in preserving his legacy and, potentially trying to kill the Fed put now that he's been instructed that that's what everybody expects him to do. That delay means he may miss the opportunity to get ahead of that.
So he might, yeah. So in making sure that the job's done, he could once again exacerbate it, but in the other direction, just as quickly as he was raising rates. If he now acts slowly to make sure the job's done, he could exacerbate any potential sell-off on the equity side.
Right. We see this, by the way, on like zero DTE options. It's part of what I've been highlighting in a couple of tweets where I describe it similar. Citadel Securities is not dissimilar to a rodeo cowboy roping a calf, right? The calf tries to get away. The rodeo cowboy tries to head it off, get in front of it, and then tie it up, right? If the rodeo cowboy sat there and was like, should we catch the calf? What do you think? Should we catch the calf, guys? Like, eventually the calf is going to get enough of a head start that the next moving forward causes the calf to run even faster and further away, right? It gets harder. It's the same, use that same imagery in thinking about this component here. Unless they cut rates really fast,